Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Professor Yang Jun-Suk of the Catholic University of Korea. Professor Yang, good afternoon. Thanks so much for coming on today.
Happy to be here.
Well, stocks on Wall Street ended a rough week on Friday with somewhat of a rebound for tech shares. The Nasdaq about 1.4% higher, the Dow and the S&P closed lower. The futures are higher right now, though. What's the story in the global markets?
Okay, well, markets have been in turmoil since Fed's giant step that it took on Wednesday, raising the rates by 0.75%. And while the markets rose slightly on the day of the giant step, it drastically tanked on Thursday, much like what happened when the Fed raised the rates by 0.5 percentage point in May. Now, the Fed also released their so-called dot charts, which showed how Fed FOMC members expect interest rate to be at the year end. And there was a drastic rise compared to the last dot chart that they released in February. So in the latest dot chart, the FOMC members expect the year-end interest rate to be around 3.5%, and next year, year-end interest rate to be around 3.5 to 4%. So this is a significant rise over the last dot chart, which showed that the FOMC members expected the rates to be around 2.0% at this year's end and 3.0% at next year's end. So the rates will go up much faster and higher than what the FOMC members originally expected. Now, the economists believe that the so-called neutral rate of interest, this the interest rate under normal circumstances, is about 2.0 to 2.5%. And if the dot rate does come true, then the year-end interest rate is going to be much higher than this neutral rate. So more and more analysts are predicting recession or a negative growth, and the stagflation somewhere between the fourth quarter of this year and the first quarter of next year. And the Fed's releases also show that the growth rates for 22 and 2023 have been revised downward by the FOMC members as well, from 2.8% to 1.7% this year, and 2.2% to 1.7% next year. This is not quite a recession. The rule of thumb for the United States is that you need 2 straight quarters of negative growth to have a recession. So they are not expecting a recession, but they are expecting softer growth. And the Biden administration and the Fed officials are now going around arguing that while it's becoming more and more difficult, recession can be avoided. So there's that conflict between the private sector analysts and the government officials. Note that, though, most of the first quarter statistics show that U.S. job market and demand is strong. The May job creation was 328,000 jobs. Wage growth was 0.3% in May. 5.2% over 12 months in May. And the latest personal consumption expenditure figures, which is only available up to April for now, shows that the consumption expenditure rose by 1.4% in April. So in some sense, yes, analysts are expecting recession in the near future, but right now, the numbers do not seem to be backing them up. So it seems, at least for now, more of a fear than actual signs that we see in the economy. For the week, Dow fell by 5.8%, S&P fell by 4.8%, and Nasdaq fell by 4.8%. For the year, Dow is now down 18%, S&P down by 23%, and Nasdaq down by 32%. European stock markets, they also had a volatile week. Bank of England raised its rate for the 5th straight rate hike in a row. Swiss National Bank had its first rate rise since 2007. European Central Bank, after getting a report saying that the inflation in May hit 8.1% over the last 12 months, they had announced that they will stop net bond purchasing in June and raise rates in July. and several 0.5 percentage points rise seem to be on the table right now. They also had an emergency meeting on Wednesday, the European Central Bank, to create new tools to tackle the risk of what's called Eurozone fragmentation, which is an unjustified jump in the bond yields of a weaker Eurozone government. They're afraid that some of the weaker European countries will experience a debt crisis like Greece did during the global financial crisis. So they are trying to head off such a crisis before it happens. On Friday, European markets were mixed as well. FTSE was down, DAX was up, CAC was about level. Asia, China consumer price index inflation came in at 2.1% over 12 months. That's actually below expectations. Producers price index is on a downward trend as well. And China held its benchmark lending rates. It left it unchanged. Japan's latest inflation numbers for April was 2.5%, rising from 1.4% in March. But both Japan and China has announced that they will continue expansionary monetary and fiscal policies. So there will be two islands in the world where you have expansionary policies rather than contractionary policies. Today, the Nikkei was down 0.7%. Shanghai is down 0.04%. Hang Seng is up 0.2%.
Right, it is an interesting contrast here in Asia with those two islands, as you put it. Well, in Korea, stocks were down today, closing below 2,400 points. That's the lowest it's been in over a year and a half. Well, Professor, we're just going to have to wrap it up there today. Thank you so much, as always, for sharing your insights with us. We really appreciate it.
Thank you.